Bold claim: fuel prices stay stubbornly high even as oil dips, and that gap matters to your wallet more than you might expect. Now, let's unpack what's happening, why the debate persists, and what the data might mean for drivers going forward. There's been a long-running debate about whether UK drivers overpay for fuel. The question isn't just about the price you see at the pump today, it's about how wholesale costs, government charges, exchange rates, and retailer strategies all interact to shape the final price you pay. Regulators have repeatedly found that pump prices can diverge from wholesale costs, sometimes by a significant margin, which has fueled ongoing scrutiny and controversy. What the numbers show about oil and pump prices. Oil prices have fallen from the spikes seen earlier in the pandemic era, with Brent crude hovering roughly in the $62 to $64 per barrel range in recent weeks. Yet the typical UK petrol price remains around £1.37 per litre, and diesel around £1.46 per litre, even though January's averages were slightly lower, or similar despite higher crude costs at the time. Several factors influence this disconnect: currency fluctuations, the pound versus the dollar, which prices oil, refinery efficiency and capacity, and the broader costs that retailers must cover beyond the raw price of crude. A growing factor in the pricing picture is the UK's refinery landscape. The country now operates only 4 major refineries after 2 closures this year, a trend that raises concerns about domestic production and makes the system more vulnerable to shifts in carbon pricing and import dynamics. Grangemouth's closure, in particular, disrupted domestic supply in Scotland and complicated delivery logistics. Retailers say overall impact has been modest so far because remaining UK refineries have stepped up production, but the risk remains if costs or supply chain pressures tighten. The "who's right" question often centres on margins and costs. Proponents of the industry's view argue that retailers face steep, year-over-year cost increases: energy, business rates, minimum wage, national insurance, and forecourt security, costs that have to be covered. The Petrol Retailers Association claims that typical margins sit around 3 to 4% after expenses, similar to a year ago, arguing that any price rises track rising costs rather than inflated profits. Critics and researchers, including campaigns and some regulators, contend that while wholesale prices can fall, pump prices don't always fall in tandem. They point to price spikes, regional differences, a postcode lottery with substantial gaps within tens of miles, and long-standing concerns that the industry has exploited its position. The CMA's ongoing monitoring has repeatedly highlighted concerns that drivers may be paying more than they should, though the exact drivers behind those discrepancies can be complex. What regulators are doing, and what's still to come. The CMA's market study on road fuel flagged the need for more price transparency. A proposed real-time fuel finder system would show live prices from each retailer, empowering drivers to shop around and push competition. Implementation has faced political and logistical delays, but there's momentum. The government aims to roll out the fuel finder by spring 2026, with the CMA continuing to evaluate cost data as part of its ongoing review. Why the debate remains unsettled, and what could tip the balance? At heart, this is a debate about transparency versus complexity. The CMA's forthcoming update is expected to incorporate more granular cost data, which could clarify whether rising operating costs fully explain higher pump prices, or if other factors are at play. If the new data support broad price gaps beyond what wholesale costs would justify, stronger regulatory action or sharper competitive tools could follow. What this means for drivers. Expect continued scrutiny of how pump prices align with wholesale costs and retailer costs. Look for more price transparency as the fuel finder launches, helping you compare prices in real time. Be aware that refinery capacity, currency movements, and carbon-related costs can influence prices even when crude oil softens. A provocative takeaway: is the system designed to encourage competition, or does it sometimes shield price differentials? And as policies evolve, what would you prioritize: lower regulatory barriers, stronger price transparency, or targeted support for low-income drivers? Share your view in the comments. Do you think real-time price comparison will meaningfully push prices down, or will other structural fixes be needed to ensure fair pricing at the pump?